Hey, Think Realty, thanks so much for watching today and viewing and listening and always participating in the podcast. We always appreciate all the participation you have. I'm very grateful for the support that you guys provide, but also the feedback. And we've got a great guest for you today we'll get to in just a second. But I want to say a quick thank you to our podcast sponsor, which is Residential Assisted Living Academy. The Residential Assisted Living Academy introduces you to a lucrative opportunity that can yield $10,000 a month net. That's cash flow for you, but also can be passed on as a legacy piece for your loved ones. And it's also a great way to service an upcoming and growing industry of senior citizens that need great places to live. You can find out more about that at ral101.com. That's ral101.com. Our guest today is no stranger to our podcast and our world. It's Ben Fertig. Ben's with Constructive Capital. Ben, thanks so much for being on the show today. Appreciate you joining us.
Yeah, no, appreciate you having me, and it's good to catch up, and looking forward to actually catching up in person in a couple of weeks.
Yeah, for sure. So the Think Realty audience, right? Like they are made up of real estate investors, and our average listener has 10 properties or 12 properties, or maybe they have 50 properties. A lot of single family. Some of them have bridged into multifamily, some into commercial. And what I'd like for you to do, if you could do it at a little bit lower level, is explain to them the basic concept of the capital markets and how capital comes to them. I think it's the biggest misnomer in the real estate space is where this capital comes from. And because you are both at the source, you're also at the aggregate level, and you're also at the very, the highest level and the lowest level. It's like you bridge all spaces. Would you mind just give like a 2-minute overview of how this capital gets to them?
Sure. I'll try anyway. So look, at Constructive, we're generally, to simplify it, in two asset classes when it comes to private lending. The first of which is DSCR rental loans. So to any of your listener base that owns 10 to 12 properties, I'm sure that they're renting those properties out. We're also active in residential transitional loans. Those are fix and flip loans, ground up construction loans, but any shorter duration loan, of course, that at the end the underlying borrower effectuates some type of liquidity event. Now, the capital structure of each of those asset classes is a little bit different. Constructive, just because of the nature of our platform, does work with institutional money. It's a combination of Wall Street or fixed income based money and insurance money at this particular point. As all of your listeners, I'm sure, know, there's been a lot of volatility in the bond market. It's reflected in the interest rate landscape. Insurance capital is a little less sensitive to some of the nuances there, but that's generally the makeup of the capital that gets deployed into the DSCR rental loans. Those are 30-year loans, so it's pretty formative. And then for the shorter duration loans, the fix and flip loans, I would tell you that it's probably a wider range of how the capital is structured. Many of your clients and listeners, I think Realty probably borrow for some local guys. There's a lot of value add based on the flexibility of that type of capital. It could be anything from friends and family money or non-institutional sources, all the way up to that same type of bond money where those loans are effectively securitized in the capital markets, and that money generally comes with a better price, but a little bit more framework around what you can do with that capital. I mean, in order to ascertain the best cost of capital, you've got to put some framework and standards around it. So I think that there's more pliability on the residential transitional side, but I think that, from our perspective, we're really getting all of our capital from either the fixed income bond side or from direct insurance money. And then what we're doing is we're putting that out to our broker base who would then deal with your listener base, right? I think the beauty of the broker base is that, look, there's just things at Constructive that we just can't do, right? Or we don't do as well as, some of our core competencies. And I think just given where the market is now, right? And I think investors have to be selective. Supply is somewhat constrained. Deals are tougher when it comes to the calculus as to whether they work because of the cost of financing. It's just better to focus your time on relationships where, you'll end up with a broader range of options. And that's why, we do everything we can to support the broker base. And if you bring it back to I think Realty, and some of your conferences, we will support our clients at your conferences, whether we help, subsidize the cost of sponsorship or things of that nature, so that your client base ultimately, can realize more options. And that's whether those options are with Constructive or not.
Right. Yeah. Now, you, Constructive as a whole, have been doing very, very well in a very tumultuous market, right? While others that have a similar business model, as you have not done as well. And so why have you guys done so well in this last period of time that we've seen companies, large companies, literally disappear in this space? Why are you guys winning?
Yeah, I think that the big ticket item was that we ended up diversifying our capital sources very early, back to the, earlier statement just about bringing insurance money in. So what we've seen, since the beginning of 2022 was that not only did interest rates rise sharply, but I think in general, the mortgage-related capital markets just really were not functioning super efficiently. So it wasn't only just the sharp rise in interest rates. There were other structural issues with the market that really caused for fixed income, bond-related, securitization-based capital to just be inefficient. And we had started diversifying. I think you and I have talked about it many times since then, back in the first quarter of 21. And at that point, everybody was just, effectively capitalizing their business through fixed income and the bond market. And, we decided to partner with a life insurance company. You would know them for sure by name, but, and look, we made a little bit less money on, loans that we delivered there, but in turn, we were able to put forth a, forward relationship where, they committed capital to us over time. We were locking in pricing 45 to 60-day periods where the rest of the market was trying to keep up with not only the rates going up, but also, the issues that were causing rates to go up even higher than market rates were because of the aforementioned dysfunction in the market. So that was the big ticket item. I think that really allowed us to pick up a lot of market share in a market that, likely wasn't growing, right? Because I think if you look at, organic demand in general at, DSCR rates in the high eights and, residential transitional rates in the 11s and 12s, relative to where they came from, it was a market share phenomenon that, is directly related to what you were mentioning before, where we saw either the, consolidation, or the closing of several competitors that, did have good market share, but weren't diversified, and made some mistakes when it came to their administration of the capital markets. So that's the big ticket item. Again, when the market's this challenging, though, right? Because look, we're doing very well. Our volume levels are basically as high as they've been ever. but we're not making the same amount of money on those loans as we did before, right? So we're working for lower margin. Our broker clients are working for lower margin. And of course, your client base is doing everything at lower margin because financing costs are higher and, property values just haven't come down, accordingly. So
Right.
I think everybody's taken a bite out of the apple. That's kind of what we've done. We've paid a lot of attention to costs and other things that are just, fundamental areas of mortgage banking. But I think that if you really had to look at it relative to the rest of the market, it was the diversification of our capital sources and the early diversification of our capital sources relative to, some of the things that we're all familiar with that have kind of happened since the beginning of 2022.
Yeah. The real estate investor that's sitting there listening and listening to what you're saying about the markets, listening to what you're saying about broker relationships, so on and so forth. I'm curious your opinion on how important it is for these more, Main Street real estate investors that are sourcing capital. Maybe they're fixing and flipping 20, 30, 50 houses a year. Maybe they're, financing 20, 30 DSCR loans a year. How important is it for them to understand all the way upstream where the capital's coming from? Like I personally, I'm a heavy real estate investor, and I have a new construction loan on 8 new construction properties in South Florida, and worked with a broker to get the dollars, and didn't realize how scared the capital was and where it was coming from, which, the construction took a little bit longer, and it was like pulling teeth to get a 3-month extension on a new construction loan that was only a 12-month loan as it was. And it's like, because I didn't realize how scared the money was, coming through the stream. How important is it for the broker relationship, but also for the Main Street investor to understand where this capital is coming from? Like you talked about insurance sources. It's like, I know insurance very well. And I also understand insurance's proclivity to risk. And it's not, they have a lot more tolerance than a lot of other sources do. How important is it for this Main Street investor to understand where this capital is coming from?
Well, look, I think it's helpful, of course, right? I mean, I think if you're running your business and you're fueling it with financing, I mean, I think it's, to the extent that what's going to cause and affect, your terms, and obviously just to your point, the general availability of liquidity, look, I think it's a value add, but I do think that if you work with some quality brokers, right, or you work with a quality broker, they're going to have a pulse on, I mean, look, this is how they get paid, right? So they're going to have a pulse on where this money's coming from, what's available, and, what lenders provide what type of products, right? As we know, lenders all have, differences when it comes to risk tolerances, pricing, right? I mean, we'll work for very low margin, because we're a high volume, lower margin, but there's certain things that we won't do that others will. And I think you can lean on your broker base for a lot of that expertise. Yeah. Now, look, I think that, it's certainly helpful to understand that, if rates are rising quickly, do you want to ask questions when you're at the time in a relationship if somebody has access to insurance money? And I think look, insurance money is rate sensitive also, but it's not as sensitive to some of the nuances in the securitization markets that cause rates to go even higher than, the market rates are driving them. So I think it's a value add. I think there's other ways to, lock that knowledge down. And I think, and that's why, I was out, I met with a couple of clients last week in person, right? I mean, and, they can tell me things that I don't even know are going on in the market, right? Because, I'm pretty focused on what we're doing at Constructive, and, I mean, through yourself and some of your other verticals, I mean, we have a good network where we all kind of are able to communicate about what's going on. But, they're the ones that really are the experts when it comes to finding capital. I think they could tell you pretty quickly, what, from an availability perspective, and a price perspective, what's out there.
Yeah. When you kind of last question, when you look at the market, I mean, I hate the crystal ball question because, I mean,
Yeah.
who knows? And we're in a market that's moving so much. But are there any changes that you see coming in 2024 that you can kind of count on? I mean, I'm not going to ask you like where the market's going or what rates are going to be or anything like that because, who knows, right? And it's all speculative at best. But what about like the more
Yeah.
consistent changes that might happen in 2024 or you feel pretty strongly they're going to happen in 2024?
Yeah. Well, look, I don't, of course, to your point, I don't know what interest rates you're going to do. I mean, I think that you will start to see some type of residual impact of an 8% conventional mortgage rate, and its impact on more macro factors. Here's what I'll tell you. One of the problems going from 2021 to 2022 was that if you remember 2021 and where rates were, I think the capital markets in general were, drinking out of the fire hose when it came to residential mortgage assets. I mean, they just took on so many of them that in 2022, obviously we had the interest rate pressure, but you also had a little bit of rebalancing, where I think people were just diversifying away from resi assets at the same time. So again, that was part of what caused some of the dysfunction beyond the interest rate movements. So I would tell you that 2023, there wasn't a lot of, non-agency mortgage assets in general, the non-QM consumer market, right? The owner occupied type of stuff. There just wasn't a lot of that originated just because of where the rates were. I mean, on a relative basis. So I think the demand will be there. I think the supply is going to depend a lot on what happens with interest rates. And I think, look, Constructive, I think we can continue to pick up market share. I think there's others that probably can continue to pick up market share. But I think, to answer your question, as it pertains to the broader market, I would tell you that I think that there is going to be an appetite for residential investor loans. But there's a lot of other things that have to really, fall into place to maybe enhance the supply. Obviously interest rates will be one. What happens with the housing market will be another, right? I mean, you've got this dynamic now where, there's just the transient activity just not there because most people can't leave.
Yeah.
So, you're going to leave and you're going to go into an 8% mortgage rate somewhere else, right? With, the overwhelming preponderance of the market locked in under 5%, right? So, So we'll see. I mean, again, I don't have a crystal ball. I do think there'll be a demand for these assets to the extent that the supply is there. I think there's a good base case that rates could either stabilize or come in a little bit, but you and I both know, I mean, there's crazy things that are happening now. If you look at some of the geopolitical tensions, where normally you would have seen a rush to U.S. Treasuries and rates come down and they went up, right? I mean, I think after some of the news from the Middle East came out, I mean, you saw the 10-year Treasury run up over 5 after that. I mean, in prior similar instances, you would have seen a rush into U.S. Treasuries and gold, right? I mean, it's not only a different world, different market.
And it's very, very bizarre times too. Very, very unpredictable. It's also, we're in this very strange time where I've been talking a lot about just the economic capital irony, right? Like you have more capital sitting on the sideline than ever before in history, but yet we have the hardest time getting it to the actual street. You know, it's like you have
Yeah.
$2 trillion sitting out there in private equity liquidity,
Right.
and yet no private equity firms are actually buying deals right now. You know, it's like it's really fascinating, and something
Right.
has to break.
I mean,
Something
I
has to
think
break
part of the
soon.
reason, obviously, right, is that, even if you've got the equity there, you know, the financing, you're generally pairing that equity up with some
Right.
financing, and the cost
Right.
of the financing is high. And
Yeah.
quite honestly, I mean, you can get a great return on your equity by throwing in the short-term treasuries, right? I mean, you get 5.5 on a
Right.
treasury that's less than 3 months, and keep cycling it until the party ends. And
Yeah.
so to jump into a deal with a high cost of leverage, just I think on a relative basis, just isn't as attractive
Yeah.
for
Yeah.
big institutional capital right now.
And private debt funds that are popping up all over that are paying anywhere from 8 to 12% is pretty wild. You know, it's like, and those are very, very
It's hard to
appetizing.
get that calculus to work.
Yeah.
It's
Right.
hard to get that calculus to work. And
Yeah.
I'll tell you, like, so for instance, I can relate it back to Constructive. I mean, all of our warehouse financing, which is, generally the methodology that we use to fund loans, but we're table funding on behalf of our brokers and borrowers. Those are all over SOFR, and SOFR is lockstep with the federal funds rate, right? So it's like, I mean, the carrying costs on these things before we deliver them to, whether it's insurance or, I mean, there's no net interest margin anymore, right? And that's
Yeah.
with market rates in the high eights, almost nines
Yeah.
on DSCR loans at least.
Yeah.
So it's definitely different, right? You just can't count on that carry anymore. And
Yeah.
I just think there's just dynamics that, most of the, anybody who's in our generation hasn't really seen before.
Yeah. Yeah. Very, very crazy. Well, thank you so much for joining us today. I always appreciate your insight. I appreciate the support you give both the real estate investment market, but also the private lending market. Look forward to seeing you in Vegas in a couple of weeks. And,
Yeah, likewise.
I look forward to catching up. But thank you so much for joining the show today, and always appreciate your insight.
Yeah, enjoyed it. Thanks for having me.
Thanks, Ben. One more quick thank you to our podcast sponsor, Residential Assisted Living Academy. Residential Assisted Living Academy introduces you to a lucrative opportunity that can yield $10,000 a month net cash flow for you, as well as those who you are survived. Learn more at ral101.com. That's ral101.com. And then one quick plug for an upcoming conference we have in Phoenix, Arizona, March 28th and 29th, 2024. If you're a real estate investor on the West Coast, we'd love to see you out there. And as a bonus, if you'll go to thinkrealty.com and sign up for the Phoenix show, if you use the word podcast, the code podcast, you get a buy one, get one free. Bring a friend with you, an investor, a partner, whatever it is, bring someone with you. This will be the first time we've been in Phoenix, and we'll have hundreds of real estate investors, as well as great lenders and brokers, a lot of service providers. We're going to provide a lot of support for you as you are growing your real estate portfolio and investing in real estate, to make sure that you have all of that support to make sure that growing that piece for you is as seamless and as easy for you as possible. Thanks so much for joining the podcast today. It's always a privilege to serve you in this way. If you haven't seen our local, our recent magazine, make sure you go to your local Barnes & Noble and pick it up on the bookshelves, or you go to thinkrealty.com and have it sent out to your home. And we'd love to support you in that way. Thanks so much for being a part of the show today. Have a great day.